What if I told you that the system designed to measure how good you are with money actually rewards you for being in debt? Not for saving, not for investing, not for building wealth, for borrowing repeatedly and paying it back so you can borrow again. And if you have ever tried to avoid debt entirely, paid cash for things, never carried a balance, stayed away from credit cards, the system may have actually punished you for it. The credit score system is not broken. It is working exactly as designed. You just were not told what it was actually designed to do. Meet Priya. Priya is 26. She grew up watching her parents stress about debt, credit card bills on the kitchen table, phone calls from lenders, the quiet tension that comes with owing people money. So Priya made a decision early. She was not going to do that. She got her first job at 22, lived within her means, paid cash for everything she could, and avoided credit cards entirely. She had a debit card. She had a savings account. She was proud of herself. By 26, she had $11,000 saved. No debt. Not a dollar. She felt financially responsible. She felt ahead. Then she tried to rent a nicer apartment. The landlord ran a credit check. Thin file, score too low, application denied. She tried to finance a used car. Nothing fancy, just reliable. Lender ran her credit. No credit history, high risk. Either declined or offered an interest rate so high the monthly payment barely made sense. She applied for a credit card to start building history. Got approved for a $500 limit. $500. Her friend, who had $2,000 in credit card debt and a history of carrying balances, got approved for a $5,000 limit the same week. Priya sat with $11,000 in savings, zero debt, and a credit score that made her look irresponsible to every financial institution she approached. And her friend, carrying debt, paying interest every month, looked like a dream borrower. That is not a personal finance failure. That is the system working exactly the way it was built. To understand why this happens, you need to understand one thing. Your credit score was not created to measure how wealthy you are. It was not created to measure how responsible you are. It was not even created to measure how good you are with money. It was created to measure one very specific thing. How likely are you to repay a loan? That is it. That is the entire purpose. The system was built by lenders, banks, credit card companies, financial institutions, whose entire business model depends on lending money and collecting interest. They needed a way to predict who would pay them back and who would not. So they built a scoring system that rewards behavior that signals you will keep borrowing and keep repaying. Not behavior that signals you are building wealth, not behavior that signals you are financially free. Behavior that signals you are a reliable, repeat customer for debt. Let me break down what actually goes into your credit score, because most people have no idea. In Canada and the US, the scoring models vary slightly, but the core ingredients are similar. The biggest factor, roughly 35% of your score, is payment history. Have you paid your debts on time? This one is fair. Paying on time matters. The second biggest factor, roughly 30%, is credit utilization. How much of your available credit are you using? This is where it gets interesting. The system rewards you for having access to large amounts of credit and using a small portion of it, not for having no credit at all. Having no credit cards means no utilization, which means this entire category scores you as invisible. Invisible is treated as risky. Third, roughly 15%, is length of credit history. How long have your accounts been open? Someone who has carried a credit card for 10 years scores better than someone who opened one 6 months ago. Time in the debt game earns you points. Fourth, roughly 10%, is credit mix. Do you have different types of credit? A mortgage, a car loan, a credit card. The system rewards you for having multiple types of active debt simultaneously. Fifth, roughly 10%, is new credit inquiries. How recently did you apply for new credit? Notice what is not in this list. Your savings account balance, not counted. Your investment portfolio, not counted. Your income, not counted. Whether you've ever paid cash for a car, saved for a purchase, or avoided debt entirely, not counted. Not rewarded. Sometimes penalized by absence. The system does not know or care that Priya has $11,000 saved. It only knows she has not borrowed enough. Now, here is the deeper issue. The system does not just ignore wealth building behavior. In some ways, it actively pulls people toward debt dependent behavior just to maintain a good score. Financial advisors will genuinely tell you keep a credit card open even if you do not use it, because closing it hurts your score. Carry a small balance occasionally to show activity. Take on different types of credit to improve your mix. They are not wrong within the logic of the system. But step back and look at what that advice actually says. Borrow money you do not need. Keep debt accounts open indefinitely. Diversify your debt. Do this not to improve your financial situation, but to score well on a system that lenders use to decide how much more debt to offer you. It is a loop, and it is designed to keep you in it. Let me show you what this actually costs people in real money. Two people, same income, same age, very different credit histories. Person A, call her Dana. Dana has been using credit cards since she was 22. She carries a small balance most months. Not irresponsible, just normal. She has a car loan she is paying off. She has had the same credit card for 6 years. Her credit score sits around 780. Person B, call her Priya. You already know her. Same income. Disciplined saver, no credit history. Score around 580, not because she did anything wrong, but because the system has almost no data on her. They both apply for a mortgage on comparable homes. Let us say $500,000. Dana at 780 qualifies for the best available rate. Let us say 5.2%. Priya at 580, if she qualifies at all, might be offered 7.1%. Or she gets declined and has to go to a private lender at even higher rates. The difference between a 5.2% and a 7.1% mortgage on $500,000 over 25 years? Dana's total interest paid over the life of the mortgage, approximately $385,000. Priya's total interest paid, approximately $535,000, $150,000 more. Not because Priya is worse with money, not because Priya is higher risk, because Priya did not play the game. The person who avoided debt her whole life pays $150,000 more to borrow money than the person who spent years carrying balances. That is the credit score tax on responsible people who are never taught how the system actually works. So, what do you actually do with this? Here is the honest answer. You cannot opt out of the credit score system and live comfortably in the modern economy. Landlords check it. Lenders check it. Some employers check it. Some utility companies check it. You need to play the game, but you play it strategically, on your terms, without letting the game play you. Here is exactly how. Step 1. Get a credit card and use it like a debit card. One credit card. Low limit to start if needed. Use it for purchases you were already going to make, groceries, gas, subscriptions. Pay the full balance every single month before the due date. Zero interest. Ever. You are not borrowing. You are using the card as a payment tool and letting the system record your on-time payment history month after month. Your score builds. The bank collects nothing from you. You win the game without playing by their rules. Step 2. Never carry a balance unless it is a genuine emergency. Carrying a balance means paying interest. Credit card interest rates in Canada and the US typically run between 19 and 29% annually. There is no investment on earth that reliably returns 20% a year. Every dollar of interest you pay is a dollar your wealth cannot keep. Pay in full, every month, without exception. Step 3. Keep your oldest credit account open, even if you do not use it, even if you got a better card. The age of your credit history matters to your score. Closing your oldest account shortens your average credit age and can drop your score noticeably. Keep it open. Use it occasionally for a small purchase. Pay it off immediately. Let the age accumulate. Step 4. Do not apply for multiple credit products at once. Every application triggers a hard inquiry on your credit report. Multiple inquiries in a short period signal financial stress to the system and temporarily drops your score. Space out any credit applications by at least 6 months. Step 5. Check your credit report annually and dispute errors. In Canada, you can get your full credit report free from Equifax and TransUnion. In the US, annualcreditreport.com gives you free access once a year from all three bureaus. Errors on credit reports are more common than most people think. Wrong account information, accounts that are not yours, late payments recorded incorrectly. Every error that stays on your report costs you in the form of a lower score and higher borrowing costs. Find them, dispute them, get them removed. Here is the reframe I want you to walk away with. Your credit score is a tool. It is not a grade on your financial life. It is not a measure of your worth. It is not a report card on how responsible you are with money. It is a number that lenders use to decide how much to charge you for borrowing. That is it. A high credit score does not mean you are wealthy. There are people with 800 credit scores drowning in debt. There are people with thin credit files who have quietly built hundreds of thousands in investments. The score measures your relationship with debt, not your relationship with wealth. The mistake most people make is they start optimizing for the score instead of optimizing for their actual financial life. They make decisions, keeping debt accounts open, maintaining balances, avoiding paying off loans, not because it helps them financially, but because it helps their number. The goal is not a good credit score. The goal is financial freedom. A good credit score is useful along the way. It saves you money when you need to borrow. It opens doors. It is worth maintaining strategically. But it is a means, not the end. Priya does not need to become someone who loves debt. She needs to learn the minimum required to score well, pay on time, keep utilization low, maintain a long account history, and then get back to doing what she was already doing: saving, building, not borrowing. The system was not built for her, but she can learn to use it without letting it use her. You are going to interact with the credit system for the rest of your financial life. Mortgages, car loans, rental applications, maybe even job applications. The score matters. Pretending it does not is expensive. But here is what I need you to remember when you walk away from this video. A perfect credit score built on a foundation of managed debt is not the same as wealth. One tells lenders you are reliable, the other tells your future self you are free. You can have both. Play the game well enough to keep your options open. One card, paid in full every month, history growing quietly in the background. And then spend your real energy on the things the score will never measure: your savings rate, your investment account, your net worth growing year after year, whether any lender is watching or not. Priya had $11,000 saved at 26 with a thin credit file. The fix was not to become someone who loved debt. The fix was 30 minutes of understanding how the game works. Now she has both: the score she needs and the wealth she was already building. You can too. Drop a comment and tell me, did you grow up being taught about credit scores? Or did you find out the hard way like Priya did? Tell me where you are with your credit right now. I read every comment and I will tell you exactly what I would focus on first. Subscribe to Nuella Invests. Every week, we pull back the curtain on the financial systems that affect your life and nobody properly explained. See you in the next one.